Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Heagren. Hey, Doug.
Hey, Kirk, if you could talk that eloquently, you might just have a career in politics. Excuse me.
I can run for president, Doug. You think? You think I'd have a shot?
Absolutely. He was just up in my neck of the woods last night doing, unfortunately for him, it's not political. It is a fact. He had one other wonderfully viral speech that nobody's really sure what exactly he was supposed to be saying, but it was up from a brewery up in Superior, Wisconsin, which is right across from Duluth. Not sure. Again, unfortunately, the impact of whatever his speech is, I don't think anybody knows what the speech was because the only thing going around is the clip of his introduction.
That's the secret, Doug. Only
Yeah.
speak at breweries because you have an excuse. Sorry, I was drinking some
That's
other
right.
stuff. It was really harsh.
There's some really good memes going on there. This is how I would speak if you asked me blah, blah, blah question after 6 beers.
we had a mayor in Boston. His name was Mayor Menino. We used to call him Mumbles Menino because you never understand what the guy said. He was just like mumble stuff, and it was just. I mean, the guy was. I don't know how many terms he's in there, but I think he was in there forever. It's a technical term, but that guy was in there forever until he finally stepped down. But
listen, look at the good side, right? What are we always doing with our politicians? We're finding and digging up things from God knows when, how many years ago that they said that we can use against them. If you marble every one of your words, they can't hold anything against you ever. So, I mean, this might be one of the greatest, political strategies I've ever seen.
what was that movie? I'm trying to remember the movie. I think it was called Snatch, with which had where it was Brad Pitt was like the gypsy, and he was just talking, and he was like, "What did he say?" He was like, well, "You don't speak gypsy." It was hilarious.
Yep. I think it reminds me of Billy Madison too, when he's like trying to talk to his French gardener, like to try to teach him French. What did you say? Huh?
Dabadoo, tell you who. Oh, too funny. Well, I have to say, we said this last week, and we'll say it again. Like, if you get nothing else from this election other than maybe heartburn, you're definitely going to find a lot of laughs. This election will be, if nothing else, it'll be funny. The memes going around, the stuff. I mean, it's just. I have to say, it's brilliant. Thank God for. If I don't love social media. I actually hate it. I think it's a plague on society in so many reasons. But I will say, if nothing else, it is great humor in this time of year because the memes. The talent, I have to say, like, I don't know what it is. Like, these people put together memes for free. The amount of talent in this country for humorists, like, you could create a whole new industry for like professional meme artists. Some people are so brilliant in their stuff. It's like, wow, they should start like one of those GoFundMe accounts. Just start raising money. I would happily contribute to their humor. It is so good and so brilliant. These people, it's like part-time job just for fun, but I would love to see more of it. That's all I can say.
I hate to break it. I hate to break it to you, Kirk. Unfortunately, while that might be a rising job opportunity, it might be one that only lasted 2 minutes because I heard today they were talking about some memes that came out over the last couple weeks that were AI generated, and they're hysterical. So unfortunately, AI is making meme creation obsolete now after like the 3 minutes of fame. So
I'm gonna want to see those, Doug, because I was playing around with AI for the last year, and the one thing it doesn't have is humor. It is really good at regurgitating existing humor. So it's funny. One of the, if you think about like AI and language in general, right? Like, one of the hardest things to do is slang and humor because it requires a lot of nuance and understanding. And so when AI came out, all I did was I kind of gaslit it quite a bit, but I also did a lot of humor tricks. I said, "Tell me a joke, tell me another joke," and I would just tell it, like, repeat another, and like after I forget, it was like 7 tries, it would start repeating the old jokes. So it wasn't like there were limitations to it with the humor, and the humor was borderline. Like, it was okay. It was like, okay, this is probably good for a dad joke. It's probably good for like a kid joke, but like an adult, there's no humor there. And I said, all right, tell me a riddle. It doesn't understand riddles. So I think and the new versions may be better at this, but I haven't seen any really good humor coming out of AI that's not like all right, you got the base of the joke, but it's not funny. You
Yeah.
know, it's like a kid who's got the timing off. It's like the joke's kind of funny, but it's like what's really funny is the timing is so bad. Like when my kids are like 6, they tell a joke and like the timing was so bad it was funny. You know what I mean? Like that's AI. Like
Yeah.
it's just a little
You,
off
you,
base.
you're right. I think that some of the AI stuff being created is the imagery or the graphics are being created from AI, but there's still that human component that's telling it, listen, I want you to create that around it. Listen, Oscar Wilde said it. Sarcasm is the lowest form of wit, but the highest form of intelligence, right? So if you can figure that out, I mean, sarcasm, Harvard, I don't even know if we should be quoting anything from Harvard these days, but they did a study that and published that sarcasm increases creativity for both expressioners and recipients. There's lots of stuff out there about the connection between sarcasm and intelligence. It takes an emotional intelligence to be able to create sarcasm that AI and the computer world, at least as of date, has no concept of being able to to be able to create, because it can't get the emotional side of it. It's like computers are still very much, although they've gotten much more broad into what they process, goes back to 2001. It's like still a little bit of how I can't do that, Dave. Like they're still built into very rigid parameters, and sarcasm crosses over that gray area so much into being a black and white, language, but yet a very gray emotional extra overtone. So
Here's
yeah,
a here's a
I
question for you, Doug.
yeah.
So I bring this up, and we'll get to the investment stuff in a minute, but I always find this stuff interesting. So I'm very sarcastic. I've always been very sarcastic. It's the way I was raised. It's just I guess I'm really smart according to your standards. Although I have very low form of
I
wit,
have very low standards. So
very
there you
low,
go.
very low form of wit. But one thing I've always found is my sarcastic tone does not come across very well in text, and
Mhm.
I wonder. I mean, I imagine because I'm not good at it, I mean, writing is not my strength anyway. I have to work really hard to be good at it, and when it comes to using sarcasm in text, I don't know if it's really that easy to do unless you're writing a big story and the nature of it is sarcastic. It's sarcastic, but like a paragraph, I don't know how easy that is. So I wonder if the limitations in the language, in the large language models that they're using, I wonder if the limitations are actually in the text itself as opposed to tone and tempo of the voice, which is much easier to pick up, right?
Yeah.
So
Yep. It
so
definitely tone and inflection and things like that make a big difference. Like I love licking shoes. Or I love licking shoes. I mean, you get that
yeah,
difference in the way you say it has a completely different impact. And you're not alone. And there has been plenty of people who have tried to communicate. Don't, be very careful what you say when you're texting or writing an email, because trying to imply those nuances just doesn't come through. And actually that inflection is something that even in communication a lot of people bat it. I mean, a lot of times people who are very sarcastic have a difficult time in social settings, because the sarcasm, while it may be intended to have a levity of humor, unfortunately, in the way they present it, the way they communicate it, in their way they inflect, is perceived by the recipient as very serious, and then it goes from funny to jerk very, very fast, right? So
yeah.
and I think you're right. In written, you can't get any of that, so it is extremely difficult, and it is an extremely uh, high level of compliment to anyone that does have that capability of being able to get that messaging through written text in a way, which is why you go back and look at some of the great satirical authors, people like Oscar Wilde in a lot of ways, and there's definitely more modern days. Nobody's I've had some names in the back of my head that are just not coming to me, but they stand out for a reason, because the writing. Bill not Bill Buford, the drummer, Bill Bryson. There's a great example. He has written countless books, like, From Neither Here Nor There, which is incredible. If you're ever going to travel to Europe, You got to go read this book. It is all about his beatnik travels in the 60s. And then he goes back later and relives it in the stuff that he talks about in each city and the nuances of the different cultures and behaviors. It's hysterical in a very sarcastic way. You have to appreciate that. They did a movie on one of his, Into the Woods, or A Walk in the Woods, which they actually did with Robert Redford, which is a remake of his book, which basically walked through his time traversing the Appalachian Trail. But people like Bill Bryson are extremely rare, that they can take that level of comedy and sarcasm and put it down into writing. Obviously, comics have the advantage of pictures. You go back to people like Calvin and like Bill Watterson and Calvin and Hobbes, or you go back to Gary Larson and The Far Side, and they're classics for a reason. They continue to transcend time with their ability to take seriousness. And actually, South Park has done this in a very, very, very strong way that has transcended now 20 some years, still popular, still humor, still taking stuff that we deal with financially, emotionally, socio-politically, and taking it away to create humor. They have the advantage of putting pictures and tone in. I mean, at least South Park does, and anytime you do something on TV with tone and inflection.
But that gets into and somebody actually uses the other day, so I'm going to use this as a quick example. Let's move on to the finance before people tune out. But I was listening to somebody talk about this in like tone and tempo, and they're like, it's like I said hi to her, right? Just flat. I said hi to her. I said hi to her. All these things mean different things. I said hi to her. I said hi to her. I said hi to her. Like each one of those, you can induce that. Like I said hi to her means you didn't say hi to somebody else, or like I said hi to her instead of somebody else saying hi. So like each of these things mean different things, right? And if you put that in text, it just means I said hi to her. It's just a flat, emotionless thing. And so anyway, I just say it because I think the large language models and AI are really interesting, and they're going to continue to evolve, and at some point it'll be dangerous. But until they can start getting the verbal aspect, I think there are going to be some limitations in its learning, because you can't. The vast majority of people cannot communicate via text with sarcasm and humor in the same way. Some can, right? And dad jokes are great for dry humor, and you could do dry humor on there for sure. But certainly it's harder to do the more complex humor, which I think our society is a little bit lacking in humor right now, which is a totally different problem. But anyway,
I'll leave it with this. There's a reason there's a certain curse word, Kirk, that they say that depending on how you use it in a sentence, it has like 20 different meanings. I won't say the word here for the public, but most people know what I'm talking about. It's all about inflection.
Yeah, I mean that brings up the old George Carlin, the 7 words you can't say on TV. That was a brilliant skit. At a time when it would actually, when you said it, it actually made sense. Now it's not as much meaning.
Well, now they say it on TV, so whatever.
I know, now no one cares. But, that was when people had different standards, rightly or wrongly. All right, so let's get started into the financial stuff. So I think what's interesting in the last week is we had an all-time high on the S&P 500 in the last week, which, yay!
No sarcasm there. Oh, you used it. Great.
Yeah, it's but I think it's interesting is I'll get into this a little bit, and we certainly have seen an all-time high in the Nasdaq. We have not seen that in the small caps and the Russell 2000, even though they've been outperforming the other indexes. They're still within a range, and so if you look at the Dow is, I think, also hit an all-time high. So I think it hit all-time high. So you really have the major indexes which have hit all-time highs, which in itself is bullish. So I just want to be clear. That is a very bullish sign when all the indexes are hitting all-time highs. So small caps are a little different. The Russell 2000, it's an index, but it's not a major index, and there's not major money going in there like the other three. So you just be aware, even though it is a sign, though. The small caps are not keeping up is an important signal. But what's most important is that the big three are hitting all-time highs, and you should be aware of it, which means as long as they're at all-time highs, you should be long the stock market. And this doesn't mean go all in. This doesn't mean go crazy. This doesn't mean it's going to go up 100%. It just means that it is a bullish signal when all the indexes are at all-time highs.
There's
So
got
take
momentum. There's
right.
momentum.
Well, yes, in itself, it gives momentum. It's a self-fulfilling prophecy. So all-time highs lead to more all-time highs because people say, "Oh, it's an all-time high." So there's this, and this is where it gets into like the mental wrestling, which is part of the reason I want to bring this up. So a lot of people, a lot of technical traders will say, "Well, all-time highs are a good thing. That means more all-time highs." But if you think that through, it's like, well, until it's not, right? Because the market does go down sometime and then it's no longer an all time high. So, yeah, sure, it's an all time high. That's bullish. That means that people are buying. That's obvious, right? Because there are less sellers than there are buyers, or it would be lower. But at some point, it goes lower. So, obviously, all time highs don't always lead to all time highs because the market has to go down. So, anytime I hear that, I just chuckle. I'm like, that's a mental pretzel that they're just trying to pull one over on you. But it is, I will say, it is a bullish sign, and you should think that we broke out of all-time highs after 2 years, basically, and that is a bullish signal. Now, this presidential year is also a bullish signal because the fourth year of a presidential term is statistically bullish, most bullish in the second half of the year, but still bullish, and people should be aware of that. So even though we have uh, basically people calling. I don't want to get into this too much, but you have an election between two weekend at Bernie's people probably shouldn't be running for president. Like him or hate him, at some point, let the young people pick it up. The problem is we don't have any young people to pick it up. So we have an election which is contentious, and at the same time, both people are like, God, can these people just go away? So I think if nothing else, there'll be a lot of humor and there'll be some interesting stuff. But I don't think there'll be as much fireworks as people think. I think the outcome is kind of a foregone conclusion at this point. And so I think people have just kind of just moved on and they're not really worrying about it. But generally speaking, if we look at this, the market kind of going sideways tends to be a bullish thing. So it's broken out to all-time highs. So we'll see. This could keep going higher. We could see a lot more upside from here. It doesn't make any sense. I want to be very crystal clear. It doesn't make any sense that we see all-time highs, or we continue to see all-time highs, or the market goes through the roof. It doesn't make any sense logically. Keep that in mind. We're not talking logic. The market does not run on logic. It runs on emotion, right? Emotion takes up 50%. People run 50% on emotion. They run 60% on emotion, 20% on logic, and 20% on fear. Generally, that's in the marketing sense, that's how the numbers work out. So that being the case, the markets run on fear and greed. Emotion, fear is an emotion too, but fear and greed are the two things it runs on. So I wouldn't be surprised if the market keeps going higher despite logic. And despite the fact that lower interest rates will cause the market to go higher, higher interest rates cause it to go lower. And yet at the end of the year, everyone was like, woo, high, we have lower rates. They're going to drop the rates down to zero tomorrow. Like that's how the market was pricing it in. And it wasn't true. And Powell came out and said he's going to start easing in his last meeting. And everyone took it as whoopity doo. We're going to go and lower rates. I think the most was 9 times. I forget which bank came out and said, oh, they're going to lower rates 9 times next year. 9 times? What are you, nuts? Like that's predicting a crash in the market. If that's the case, that's a crash. I don't think we're going to have a crash. I think we might have a recession in the second half of the year, but I don't think we'll have a crash. So these people, I mean, we could, but there's nothing pointing to a crash right now. And if that happens, we'll certainly update, the listeners here on the show. But there's nothing pointing to that at the moment. It might be 12 months away, but we're not seeing it. The market's not showing it, which is actually an important indicator in itself, as the market tends to forward indicate things that are happening, like interest rates. They were predicting, so in Q4, they were predicting interest rates going to drop. And some banks came out and said, hey, we're going to do it a lot more than the Fed says because we don't believe the Fed. And what that led to is the market going through the roof in a short period of time. And then as of January 2nd, the market dropped and now it's back up again. So the thing to keep in mind is that we don't know the future. We don't know what's going to happen in the stock market, so don't try to predict it. And when the market does turn, because it will turn at some point, you just have to be nimble enough to be able to adapt. So you have to have a plan in place. And we're going to get into this, and this is a segue into what we want to talk about today, which is good financial hygiene. Yes, Doug, I took a shower today, so good financial hygiene for your personal finance. So what we're going to talk about today is how to think about. We got started a new year. All these New Year's resolutions were 4 weeks in, and you've already shuttled your New Year's resolutions until 2025. Most of you, about 2 years in, is when people give up on their New Year's resolutions because it's too hard. The 2 year mark is when your brain starts to say, "All right, we've had enough of this. We're going back to the old thing." That's very normal for any habit you're going to change. So don't think it's you. It's your brain. Everyone's brain operates the same. So so Doug and I are going to give you a bunch of them. Here's the first one I want to share. So at the end of every year and the beginning of the new year, the beginning of the new year is the better time, depending on what your construct is. But here's what you should do. Look at your portfolio today and say, all right, my portfolio is all cash. Now, you might have all stocks. Imagine for a moment your portfolio is all cash. Now, if your portfolio is all cash, what would you do today? That is the question you should ask yourself. Don't sell everything. Imagine let's say you have 100,000 in your portfolio. Imagine you have 100,000 in cash. What would you do to that today? And think about it, right? Don't just say, "Oh, I'd put it all on Bitcoin, or I'd put it all on, I'd go to the casino." No, I'm talking about your portfolio. How would you construct your portfolio today if you had all cash? And I'm not talking about dollar cost averaging or any of that garbage. I'm talking about what would be in your portfolio. What would it look like? And if your answer is, well, I wouldn't be in the market, I'd be all in cash because I'm afraid. Okay, then maybe you should sell your stocks, right? So this is a mental model on how to think about your portfolio. Now, if you're thinking, well, I certainly wouldn't have a big position in, I don't know, ABC Corp. Well, maybe you should sell part of your position ABC Corp so it's a manageable position. The exercise is about training yourself on how to think. Because what happens is if you have a portfolio of like 10 stocks, let's say you've got, Microsoft and Apple, which are the biggest stocks and you've owned them for 20 years, they're probably an outsized position than compared to everything else. You might think, well, it's too big. I wish it wasn't that big. Okay, think about selling it, right? I'm not saying to sell it, but think about it. Like, think about, all right, should I sell this? The reason that your answer isn't immediately yes is because you have an emotional attachment to those stocks. You've owned it for 20 years. You're like, oh, this would be a good idea. I should continue to own these. But in reality, it's an emotional attachment to those stocks because they've done so well for you. You assume they're going to continue to do well, and maybe they will. I don't know. But you assume they're going to continue to do well and you're just going to ride the train to the end. Yeah, but what if the train runs off the tracks and turns into a flaming, a heap of flaming metal? Well, obviously you waited too long. So don't be afraid to assess your portfolio every year and imagine it's all cash. It's the best exercise you can do. Now, if your portfolio is the exact same thing as if you would invest it today, then you're doing great work. Or you're fooling yourself and you didn't really do the exercise. So I'm assuming for the moment that you're all doing the exercise. But if you do it, think about it. And we all own junk in our portfolio. Every single one of us. I own junk in mine. I'm like, I wish I never bought this. I'm just going to wait till it comes back. It's like, it's like the, I don't know. It's like there's always some like black sheep of the family. Like, oh, there's Joey. He's the black sheep of the family. Like, yeah, I got one of those positions. I don't want to get rid of it because it'll come back eventually. I remember buying this Mongolian micro cap years and years ago, and then it went down like 80%. I'm like, oh, there goes that money. I mean, I didn't invest a lot. It was like $500, and didn't invest a lot. And it came back. It's actually up like 300% now. Like, I bought it right before like the housing crash in like 2008, and like I waited. Now it's up a few 100%. It's not a great company. It's just the markets have gone up, and it just whatever. The point being is like I probably should have sold it, and I probably should have sold it when it was down 20%, not 70 or 80. But But that's a totally different lesson. That was a bad example because it actually came back. I have owned things that just sit there and never come back, and that happens too. So you're just gonna say, you know what, I lost the money. At some point, you have to put in a stop loss, and this is a different lesson, but I'm going to use it a part of this lesson because it's important. If you look at your portfolio and you're like, I'm down 30%, I can't sell it. Why not? Why can't you sell it? Well, because it's down 30%. So what? Sell it. Think about it this way. If you own a stock you buy $100 worth of this stock and it goes down 30%, right? You own $70 of that stock. Okay. Now let's take two scenarios. You have $70 in that stock. Let's say for the next 10 years, that stock goes nowhere. So you're not only down 30%, but now you've lost 10 years of time that you could have been investing in compounding your money. Scenario B, stock goes down 30%. So now it's worth 70. You sell that stock and you put it into something else, let's say like an index, because I'm not going to pick stocks here. Say you put it in an index. The index goes up 40%, 50%, 60%, something like that over the next 10 years. Well, now you've made a positive choice because your money, yes, you lost it, but you made it back and it's growing and it's being a positive, it's a positive, productive part of your portfolio, as opposed to just hoping it comes back. Oh, I hope it comes back. Yeah, it's a dog and everyone hates it and there's not one person in the world that likes it, but I hope it comes back. Terrible idea. Don't do that. And everyone does it. I do it. Doug does it. Well, maybe Doug. I'm not going to speak for Doug. I do it. Everyone does it. It's normal. But this is why investing is hard, is because it's psychological and you have to understand why your brain is playing tricks on you. And this is one of the reasons it's playing tricks on you, because you don't look at it with the sense of logic of, oh, I should just sell this. And obviously time value of money. And I would make more money if I sold it and move on, right? It's not a loss. If the market goes down 30% and comes back, it's no different, right? A loss is something that you sell and you go put in cash for the next 30 years, you never make any money. Like if you sell it and buy something else, that can still go up. So it's only a temporary loss, right? If you go to the casino and you get wiped out, that's a loss. If you go to the casino and you play for 5 hours, sometimes you're up, sometimes you're down. It's a loss or is it a loss or a gain? It doesn't matter because it's not your money. It's not your money till you push back from the table and walk away. That's your money, right? Until you're done, you're just playing with money. It's just there until you actually pull away and see how much you have. Same thing with investing. It's only a loss until you pull away, or you make a really bad decision, you lose it all, which I don't recommend. It's really hard to recover from that. So you have to have some risk management. But point being is, if you think about your portfolio with a fresh set of eyes, it will give you a whole new lease on life where you can actually start making intelligent decisions and say, you know what, it's like this. Your room's a mess, and you've had enough, and you're like, this room is a disaster. I can't take anymore. I'm going to clean it. I'm going to clean everything. And you just throw everything out. That's what you're doing. You're doing a mental decluttering. You're throwing everything out. Your portfolio, sell it all. Let's start fresh. All right. I'm going to buy the same things back. Great. Buy them back. And sometimes I don't advise this with taxable portfolios because there's obviously tax implications. But an IRA, just sell it all. Sell everything. Go into cash. Wait 2 days and say, all right, what do I buy today? What do you got to lose? You're not paying taxes on it, so it doesn't matter. So sell it all and wait a day and say, all right, what would I buy back? What do you have to lose? 1 day's return? I mean, that's not the end of the world, unless the market goes up 50% in a day, which has never happened. But, think about it from that lens. And if you have an opportunity, actually do it, because you're going to learn a lot from that scenario of like, all right, great. I feel much better. I don't feel stressed about my portfolio anymore because I got rid of all that junk. What should I buy now? Well, maybe it's an index. Maybe it's a treasury. Who knows? But it'll free your mind up from the mental clutter so you can actually start thinking again. You're like, ooh, look at the world. There's so much opportunity out here. What should I buy? And take your time, right, to make good decisions. So some of the best portfolio managers I've ever met, they do this time to time. Like they'll just go clean house and be like, I'm done. Things aren't working. Clean the table. I'm going to cash. Start fresh on Monday. So don't be afraid to do that. This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, You're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1, but you're guaranteed to win the inflation lottery because it affects everyone and the prizes stink. But here's what you're going to win: higher prices at the store, shrinkflation in your packaged goods, higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today. What's next, Doug? What else is on our list of things people can do to start the year off on the right foot?
Well, I do actually a quick question on you based on what you said. So let's imagine, imagine if you were all in cash right now, okay? Because a lot of people, I think last year may have gotten a little scared, as a lot of rhetoric, especially October, things weren't looking so great. Boom, they might have gotten defensive. Now the market's gone on a run. Now they're still in cash. Now, according to the CNN Fear and Greed Index, we're at extreme greed again. The market S&P 500 in October was roughly 200 points lower, lower than the 25-day moving average. Now it's sitting at 400 points over it. Things are really good, and then as we know, that's generally a time that all of a sudden feel good. But how would you advise, someone that might have been sitting on the sidelines in fear? Now, what do they do? Right? We start in the beginning of the year. You've already got a bunch of cash. The market's relatively expensive, but as you said, going into our conversation today, there are some bullish signs, but you never know. Could be, the runs happen. And we always talk about timing because timing can bite you, So just what are your thoughts there, Kirk?
It's a great question. It's a great question, Doug, because it happened. It's actually one of the more popular mental models that happen with people with investing. Is one of the. It's FOMO, right? You get a combination of FOMO and fear. So think about it this way: if you're bullish, that is not actually a logical argument. That is a sunshine, bright sunny futures, kind of sunshine and rainbows kind of mental model. The bearish argument is always the most intellectual case. It feels the most solid. It feels the most sound. It makes the most sense, but is also probability-wise the most wrong. Now, it doesn't mean that the logic's wrong. So you could say, I think the market's overpriced. And I would say, you're correct. But you could lose a lot of money being correct, in air quotes, for those of you listening, if the market goes up another 50%, right? And so part of it is you're losing out on opportunity, right? Which everyone fears, like FOMO, fear of missing out on opportunity. I actually don't think of it that way. I don't think of it as missing opportunity. I think about it as, what are you trying to accomplish? Now, if you're trying to accomplish squeezing every nickel out of the portfolio, then you're also going to lose a lot of nickels, right? Because there's no way to optimize portfolios in the way that everyday people can do. I know there are very, very small handful of people that can do that, but most people can't. So what ends up happening is you get this fear of, oh my God, I missed out. What should I do? And I have this problem all the time because I'm a risk manager. So for me, it's always like, well, it's too high, it's too high, it's too high. And I fall into that time and time again. So you have to find a strategy that supports your weak areas. So I've got areas that I'm weak, and I know I'm weak in those areas. So I find strategies and I find methodologies that support those weak areas. Like, for instance, One of the weak areas is stop losses. I have a really hard time with stop losses because if I put a stop loss in the market and I just throw it in there, the market will actually target that. It'll drop down to that level. It'll hit the price and then bounce back up. So you can't put it in the market, with like an Apple or Microsoft. You can because it's so large, it's not going to do that. But with like a mid cap or small cap, you can't do that. Like a stock will go from 20 to 10, hit your price, and then bounce back up to 20. So you can't put it in the market. So you're basically marking this in your brain. And if it does hit that, you're just like, well, it's already gone down 50%. It can't go down anymore. Obvious. So you start to rationalize in your head, well, all right, this is a good support. It's going to stop here, and that goes down another percent, another percent. All right, well, now it's going to turn another percent, another percent. Well, it's not going to, it's this gambler mentality. You keep taking losses, and you're like, all right, it's going to come back. My luck's going to turn. Your brain goes through these mental gymnastics when you're investing, and stop losses can be really hard if you have to keep them in your head. Now, if you put them in the system and you're allowed to, that's easy. You put them in, you forget, right? Just put them in, trailing stop loss, whatever it is, that will protect you. But you have to keep it in your head. Now you're playing games with your mind. And so I always advise people to write down your rules, write down your exit strategy, write down upside and downside, like when you're going to exit, what are the rules you're going to abide by? And if you're sitting in cash feeling like you missed last year, you actually didn't miss last year. It just depends on when you got out. I mean, we went all-time highs. The last time we were at all-time highs? It was back in 2000. It was the end of 2021. So from 2021 until early January this year, it was not at all-time highs. So if you got out in 2021 or shortly thereafter, you probably didn't miss out on anything. Now, if you got out in like October of 22, okay, you missed out on some upside, but who cares, right? It's like looking at your neighbor and saying, "Oh, they're really rich. I wish I had what they have." So I know they mine for gold in the Congo, so I'm going to go mine for gold in the Congo. Like, why? Like, you can't be like them, so don't try. So who cares what other people are doing? Figure out what your goal is. If your goal is 5% a year, 10% a year, whatever it is, 10% is a little high, but let's say it's 5% a year, then focus on 5%. Don't focus on what someone else is doing that has nothing to do with your situation. We all got caught in FOMO. We all got caught in keeping up with the Joneses and what my neighbor's doing, what my friends are doing. Their life is not your life. Who cares what they're doing? Because they might go bankrupt. Do you want to go bankrupt? Like, if you follow other people, you end up doing stupid things. That's what I found. So don't follow other people. Create your own track. So what I would recommend people do, if in Doug's scenario that they've got caught behind, is put together a set of rules. Now, I have a set of rules actually around this very thing. And, because it's hard, it breaks out to all-time highs, and you're like, you know what? In my thesis, I don't see how we're going to go much higher, right? That's been my thesis for a while. Like, we're overvalued. High interest rates lead to a poor economy, which isn't being realized right away. It's starting to seep in. People are seeing it. Food prices are up, gas prices are up, everything's up. Costs are up, income's not. And so eventually people are going to feel the pinch. So I think when they feel the pinch, we're going to start to see that hit the stock market. It's just being really slow because there's so much money sloshing around. However, I also acknowledge the stock market could go up 50% from here for no apparent reason whatsoever. No logic whatsoever. It just could. And you just have to realize that. So what my rule was is if it breaks out to all-time highs, then I'm going to put a position in the market that is both giving me access to the market and at the same time not overwhelming, right? So it's not like I'm going 100% in the market. I have risk mitigation in place. So if the stock market crashed tomorrow, I'd be okay. Like, we'd be out a little bit, but not a lot. So my investment thesis right now for the S&P is, as long as it's above all-time highs, buy and hold, right? Now, if it goes up another few percentage points, like it's down today, and let's say it goes below all-time highs, I'm out. Like, I'm back out, because it means that they call that a false breakout, right? There are bull traps, bear traps. It's basically you suck people in, and then they buy, and then it goes right back down, and those people are caught holding the bag. I know I'm not going to be able to time it perfectly, so it's up. We bought a position, we hedged it, so if I'm vastly wrong, I'm not going to get killed. And it goes below the barrier, I'm back out. I'm sitting the sidelines, and I haven't lost much. You lose a little bit, but you have to account for the fact that that's a cost of doing business. Like running a business, you take losses sometimes. I'll happily take a 2% loss if it doesn't lead to a 20, 40, or 60% loss, right? And also, I take a 2% loss, but I can make a 20, 30, 40% gain. So it's worth it, right? It's like paying 2% for GBTC when it was the only Bitcoin closed end fund. Like you pay 2%, but it's your only choice. If you want something, you don't have a choice, right? I'll pay 2%. That was my thesis. I'll pay 2% because if I'm right, it's going up 200%. So who cares about two? And if I'm wrong, it goes down 70%. Who cares about two, right? It's not a dividend stock that's going to flatline where two will eat up the dividend. It clearly was like a small potatoes in the grand scheme. So I look at it as that's my thesis on that index. Now there's other stuff that's doing really well. Intel got creamed today. It's down like double digits because they had bad. They're just getting creamed left and right. And they used to be like one of the biggest companies in the world and one of the top semiconductors. Now I think they're like sixth or seventh in their own industry or something crazy. Like I don't. They fell far from the tree. So their stock's getting killed today. And that stuff's going to happen. Like it happened with Netflix a few weeks ago, and it was down double digits, and then it popped back up when their earnings came out. So this stuff is going to happen. That volatility is going to mark mostly what's going to happen this year. Tons of volatility. There's tons of people who are bearish, tons of people who are bullish, and it's going to cause these big swings. So don't be surprised to see big swings this year. But whatever you do, have a plan. Have a risk management plan in place in case you're wrong. And if you're on the sidelines, don't be afraid to get in. I'm telling you, don't be afraid to get in. Because if you wake up 12 months from now and you say, God, that market was up 50% and I'm still in cash, you're going to kick yourself. So sacrifice the 1 or 2 or 3% or whatever it is, however your risk management is, sacrifice that few percentage points for the bigger pot. But keep in mind that if it goes down, you should get out if that's part of your thesis. Don't get stuck in the weeds because then you're going to have a double loss and then you're going to really kick yourself. So don't get caught in that. That's people's biggest thing is they get caught and then they say, oh, I got to buy now because it's all-time highs when it's really risky. And then it goes down, and they lose again, and they just keep losing. That's a recipe for disaster. So whatever you do, have a plan. If you have questions, just send them to the show. I'm happy to talk about this more and more on the show. It's really important to have a plan when you're investing. If you're investing as buy hold forever, I don't love it, but it's a plan and you know the upside and downside, that's great. If your plan is to trade in and out every day, have a plan. Like whatever it is, just have a plan and stick to it. Don't jump around because of some hot, shiny object that came into, oh, look at this new stock. It's an IPO. I'm going to buy it. Have a plan and stick to it. If your plan is not buying sexy IPOs, then don't do it. Not that IPOs are a great idea anyway, but just construct a plan that goes along with your investment philosophy. I have an investment philosophy and investor psychology that works for me. We haven't talked a lot about this in the show. We used to a few years ago, the investor psychology. You need to understand your own investor psychology. The better you understand your investor psychology, the better you're going to do. I cannot invest like Warren Buffett. I can't. I could be just as good at stock picking as Warren Buffett or better, but I can't invest like him for a few different reasons. It's not my style. I also can't invest like Carl Icahn, David Einhorn, all these really smart people. I can't invest like them. That's not my style. I have a different style. It works for me. I've figured it out over years. It supports my weak areas and amplifies my strengths. So I know going in, the worst that's going to happen is X, and I could totally screw up and I'm still going to be okay. That makes me feel good because everyone screws up. And, you have to look at things. You have to understand yourself and know yourself well and be really honest with yourself. Don't tell yourself you're the world's greatest trader if you're losing 50% a year. Like, that's just stupid. Like, be honest with yourself and say, I stink at investing. And learn more or find somebody to do it for you or find a system that works for you. But start paper trading if you're really that bad and learn. Learn with fake money. Don't learn with real money. Real money is like you pass the fake money stage where you're really good at managing fake money. Then you try real money. You try small amounts, right? Take like $1,000, manage that for a while, make sure that you can deal with it, and then start increasing it over time. And eventually you get to a place you're like, all right, I feel comfortable doing this. I don't feel skittish managing, putting 100. I was talking to a client the other day. He's like, yeah, I want to take all my money and put it in the index. I'm like, why would you ever do that? Like, that's just dumb. And I didn't say that to him, but like, that was a conversation. I was like, why are you going to do that? Like, that just doesn't make sense. Like, let's talk it through. He's like, well, I feel like I'm missing out on retirement. I need to get more money. I'm like, what if you're down 50%? Well, I'll just wait. Okay, what if waiting's 10 years? Like, you're retiring in like 2 years. Like, what does that look like? He's like, well, I hadn't thought of that. I'm like, yeah, because you're focused on the upside. You're not focused on the downside. So if you don't know how you think investor wise, then you need to be really honest with yourself and say, look, I'm I'm really bad at this. What can I do differently that will hide this weak area in this, or find someone to support it. Like, if you're bad at picking stocks, find someone who's good picking stocks, right? Just find something that will offset your area that you're not good at, or get really good at it and learn and practice. That's really the best way to invest. There's not a lot of secret sauces, but that's one of them. So what else, Doug? We got a few minutes. We kind of ran up on time. We got 5 minutes. So
We only have a couple minutes left, so I think that there's going to be opportunity for us to continue this conversation next week and get in some other areas. So just with the limited time, I think I want to tack on to what you were just talking about. I'll go back to 2008 when I was getting in the market. I think as you talked about, have a plan. Geez, what a theme, right? We've funny how that comes up in almost everything we talk about. Have a plan, put the plan in action. If you don't have any plan at all, then, there's the saying is, failure to plan is planning to fail. If you are sitting in a position right now where you don't know what to do, okay, as Kirk said, set in some goals and say, look, this is what I'm willing to take. Watch that plan, work that plan. The reality is that I know that some people listening are not going to necessarily either have the time or put the time to watch things closely. So I go back to 2008. Again, this is an investment advice, isn't what to buy. But when we were looking at what was happening in 2005, 6, 7, 8, it got to the point where, just like now and just like the late 90s, there became points where it was becoming more and more difficult to break out logic and emotion of what's going to happen here. Again, the irrational exuberance speech of Alan Greenspan, that irrational exuberance continued for thousands points more after he said it. That's the emotion of the markets, right? The logic could be screaming, everything is poised for implosion, but it could be years or ever before that happens, because there's too many variables that can come into play. And as we know, there's an old saying, follow the Fed. The Fed has proven time and time again, has a lot of control in this. So what we were doing at the time, especially with individuals that may have come in with a lot of cash for various reasons, is we would say, we would take a look and say, okay, you can't be completely out of the market because, like Kirk said, we don't know what's going to happen. The next couple of years, you don't want to be sitting all in cash and it goes up and you've missed out. But at the same time, there's that risk of, what if the markets start to unwind after you put that cash into place? So this is where you could consider something that is almost a split dollar cost average type of situation. Take some, whatever that is, whatever you're comfortable with, 20%, 30%, 50%. Move that in, and then you have that exposure. And if the market goes up, you're going to be happy that you had a position. Now, what about the remainder of it? Now this is where you can have a plan and say, I'm going to go in if it does this, or I'm going to pull out what I put in if it does this. Or you can set some triggers or some systems. And so some of the ways that I've heard, again, it's not advice, or some ways that people use it, you take the remaining amount over 12 months, boom, dollar cost average. That way, if the market keeps going up, you're continuing to add. And if it drops down slowly, you're continuing to add, okay, and buy it at cheaper values. If it drops significantly, then you can stop, and now you have your cash where you can maybe make a more strategic move. So you watch and plan according to what the markets do. But if the markets are just being volatile, it allows you to be able to take and systematically move in. Now, I've seen some where you break it into multiple ways, where, okay, a lump in, 6 month, maybe move a piece over 6 months, a piece over 18 months. Well, 6 and 18 average to 12. So there's a couple ways that you can do that to be able to get back in with exposure that doesn't take more risk. But again, you're going to have to take action and get that system in place, and you're going to have to battle between logic and emotion to do that. But having everything fully invested, that certainly exposes you to an unlimited amount of risk. Having nothing invested also exposes you to a limited amount of risk. Maybe not on market declines, but certainly on not being able to combat long-term inflation. So there's a couple additional ideas that that you could think about based on what we've talked about so far today. I think in the future, one of the things Kirk and I can address is things you might be able to do around tax management, cash management, things to get your financial house in order and keep it that way forever. We'll talk about that a little bit more here, probably over the next couple of weeks, because I know it's a great time to reassess. Think of your household as a business, because it is a business. Just like any business, there's revenue, there's income, profit, etc. And we'll talk about how to relate those two things together. Again, find more information on me. Again, the business of college planning. If you have a child that's in high school, you're going to be looking how to pay for college and you don't want to overpay. I mean, if you do, ignore this. If you don't, maybe do the work to get a little bit of information. Download our free report. Quickly find out what you can afford, what colleges think you can pay, maybe some colleges that are out there, or what some colleges you're looking at are going to cost. Just go out to ProCollegePlanners.com, ProCollegePlanners.com. Download the free report, get some basic information. And again, like Kirk said earlier, if you have any questions, let us know.
Great. Well, Doug, I really appreciate you coming on the show as always. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.